Have you ever heard someone say that investing is only for the wealthy, or that renting a home is a financial mistake? These misconceptions about money and investing are more common than you might think, and they could be preventing you from making the most of your financial potential. So, what if I told you that these beliefs might not be true? Today, we're diving into 10 common myths about money and investing that are holding many people back from reaching their financial goals. If you've ever wondered whether these myths are true, then stick around as we debunk them and show you how to approach your finances more effectively. Let's jump right in. Myth 1. You need to be wealthy to start investing. One of the most common myths is that you have to be rich to start investing. This is simply not the case. In fact, the earlier you start investing, the better, regardless of the amount of money you have. Thanks to modern technology and financial tools like fractional shares and micro-investing apps, it's easier than ever to begin your investment journey with just a small amount. Small amount can add up over time, especially when compounded. The power of compounding means that the money you invest today can grow exponentially over the years. Think of it this way. If you invested $50 every month for 20 years, that would add up to a significant amount, even if it doesn't seem like much at first. Don't let the idea of needing a lot of money stop you. Just start, even if it's a small step. Myth 2. Debt is always bad. Another myth that many people believe is that all debt is bad and that financial freedom means being debt-free. While it's true that high-interest debt, like credit card debt, can drag you down, not all debt is created equal. For example, mortgages and student loans are often considered good debt. A mortgage allows you to buy a home, which can appreciate in value over time. The key is to manage your debt wisely, not avoid it altogether. The goal is not to eliminate debt, but to ensure that any debt you do have is working for you. Myth 3. Investing in your home market is a safe strategy. Many people believe investing in their home country is the safest bet. While it might feel familiar, this idea can be dangerously limiting. No market is entirely free of risk, whether it's your home country or somewhere else. For example, just think about the impact of Brexit on the UK stock market or the Greek debt crisis. In today's globalized economy, markets are connected, and placing all your money in one country can leave you exposed to localized risks. A well-rounded portfolio includes global exposure, not just investments in your home market. Global diversification is an important step in managing your financial risk. Myth 4. Timing the market is key to success. Another myth that trips up many investors is the idea that you need to time the market perfectly to succeed. In reality, timing the market is incredibly difficult, even for professional investors. While it's tempting to think you can predict the best time to buy low and sell high, the truth is that trying to time the market often leads to missed opportunities. Instead, focus on time the market, not trying to time it. Staying invested for the long term, even through the ups and downs, allows you to benefit from the power of compounding. The market naturally rises over time, despite occasional downturns, and long-term investors tend to see positive results. The best strategy is to stay consistent with your investments and avoid trying to make short-term gains. Myth 5. Cash is the best safe haven during crisis. When a financial crisis hits, many people think that hoarding cash is the safest way to protect their wealth. While it might feel comforting to keep cash on hand, it's important to remember that holding large amounts of cash can actually hurt your financial growth over time. Why? Because inflation erodes the value of cash, and you miss out on investment opportunities. Instead, consider investing your cash in assets that appreciate over time. Even during a crisis, you can make strategic investments in stocks, bonds, or real estate that can grow in value and outpace inflation. The key is not to panic and hoard cash, but stay informed to make smart financial moves, even in uncertain times. Diversifying your portfolio with a mix of assets will help ensure your wealth continues to grow. Myth 6. Gold is the best hedge against inflation. Gold has been a traditional safe haven asset for years, but it's not the inflation hedge many people believe it to be. While gold can be part of a diversified portfolio, it's not the miracle asset people think it is. For example, during high-interest rate periods, gold has historically underperformed. From 1988 to 1991, while the U.S. dollar lost value due to inflation, Gold actually lost value during the same period. In contrast, stocks have proven to be a much better hedge against inflation in the long run. Gold doesn't offer dividends or growth, so while it can be a piece of your portfolio, don't rely on it as the sole inflation protector. Myth 7. Only speculators buy stocks. Many people mistakenly believe that only risk-seeking speculators should buy stocks. However, this is a misconception. In fact, stocks are a key component of most long-term investment strategies, including those aimed at wealth preservation and growth. The key to successful stock investing is diversification and having a long-term perspective. Rather than focusing on short-term gains or trying to pick individual hot stocks, consider building a diversified portfolio of stocks that reflect your risk tolerance and investment goals. Over time, staying invested in quality companies can provide significant returns, benefiting from the power of compound interest. Myth 8. Intuition is better than strategy. It's easy to think that our intuition can guide us to making good financial decisions, especially when markets are volatile. But in reality, relying on intuition often leads to poor decisions, like selling low during a market dip or buying high during a market rally. Instead, it's important to have a clear strategy and stick to it. A well-defined investment strategy takes your goals, risk tolerance, and financial situation into account. Working with a financial advisor to create a plan tailored to your needs can help you make decisions based on logic and analysis, not emotions. When you have a strategy in place, you're less likely to be swayed by market fluctuations. Myth 9. Bonds are safer than stocks. While bonds are often considered safer than stocks, this myth can be misleading. In the past, bonds have performed well due to falling interest rates, but that's not always the case. In fact, over the past few years, many bonds have underperformed, and some have lost significant value. Bonds also don't offer protection against inflation, making them less attractive in a rising interest rate environment. Instead of seeing bonds as inherently safer, think of them as one part of a diversified investment strategy. A balanced portfolio with a mix of stocks, bonds, and other assets will provide more stability and growth potential over the long term. Bonds can play a crucial role in providing steady income and balancing the risk in your portfolio, but they shouldn't be the sole focus of your investment strategy. Myth 10. Investing in the stock market is like gambling. One of the biggest misconceptions about investing is that it's the same as gambling. In reality, investing in stocks, bonds, and other assets is based on sound financial principles, whereas gambling relies purely on luck. When you invest, you're purchasing a piece of a company or asset with the expectation that its value will increase over time due to the company's growth, earnings, and market conditions. Unlike gambling, which has unpredictable outcomes, investing is about creating a diversified portfolio, managing risk, and staying committed to long-term financial goals. By sticking to a disciplined, research-based investment strategy, you can increase your chances of success rather than relying on chance or luck. There you have it, 10 common myths about money and investing debunked. The world of personal finance and investing can be confusing, but now that you got the facts, it's time to take charge of your financial future. Remember, it's not about making huge leaps. It's about making informed decisions, staying consistent, and sticking to strategy that works for you. If you found this video helpful, don't forget to like, share, and subscribe for more financial tips and advice. Let's continue breaking those myths and building a brighter financial future together.